Ryan Reynolds here from Mint Mobile. I don't know if you knew this, but anyone can get the same premium wireless for $15 a month plan that I've been enjoying. It's not just for celebrities. So do like I did and have one of your assistants switch you to Mint Mobile today. I'm told it's super easy to do at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
I never realized how good a market timer I am. I'm just brilliant when it comes to timing the interest rate market. I'm brilliant. Brilliant. I got my refi mortgage at 2 5/8 for 30 years.
I hate to brag, but mine's a little less than that.
Oh,
actually.
darn it. My timing's not as good as yours. What's your rate?
I think it's 2.45.
Oh, I have rate envy now.
Sorry. Yeah.
Well, all right. Now I feel bad. Even though mortgage rates have risen. They've risen.
Yeah, they've gone up. I mean, you're looking at a 30-year now at 3.2.
Okay, that's about a half.
I mean, you and I got in literally right at the bottom.
Yeah, I'm happy being at my bottom.
No. But here's the thing. And you didn't mention the phone number. So
no, I will, but I figured we'd just start talking and then we go to it. Yeah. But the phone number is 855-935-TALK, TALK, 8255.
We have a closet full of questions, but your questions via phone always move to the top.
Oh, always.
But here's the thing. I mean, so mortgage rates are higher. Bond yields are going to start inching. I mean, they already have right to 30 years now, like 1.7. But here's the part. Here's where the trouble starts. People are sure that the Federal Reserve will raise rates 3 times in 2022.
Well, they basically said they would.
Yeah, they
hinted at it, but
they've done this before where they said, here's kind of what we're thinking.
Mm-hmm.
So, and people start anticipating, like, okay, so what do I do?
Well, most of the smart people have already done.
My point. You don't do. Your portfolio is about you. It's not about the Federal Reserve.
Well,
it's not
and
about
also
what's coming next.
The market doesn't have any. The market is smart enough. Most of the people involved in the market are smart enough to know they don't know the future. All they can do is act upon what they believe will happen based on what somebody says will happen. And then if it's surprising, then it reacts.
Well, we're already seeing people make moves in anticipation of higher rates.
Right.
And that's not a good investing philosophy.
What's better?
It's a timing move. To have, as you said, to have things in place for whatever is next. And that sounds a little self-serving, but yeah, your stock to bond ratio, the type
boring.
Of stocks.
It just sounds so dull.
Okay, it's boring, but
I'm going to go listen to music radio now.
Well, we could do music.
Or I'm going to go listen to somebody selling those stupid health supplements that don't do a darn thing.
Because we want to help you. Speaking of that, stop bad habits when it comes to your money. That's one of the big purposes of the show, right? To help you build the right plan, stick to it, not change things when it looks so obvious. And
whoa! Looks so obvious to whom?
Well, that's what I'm saying. It's
Mr. Man.
Interest rates. Okay, here we go. Yeah? Interest rates have to go up in 2022.
Right. It seems obvious.
They got to.
Gotta.
Federal Reserve said so.
They
got to
did.
do it. And Jason Zweig points out in today's Journal, they said that a few other times along the way. The 90s. Here's what we're going to do. Well, we changed our mind.
Well, and there's another interesting point that nobody talks about. The Fed only has control over short, like hours long rates. Hours long, not weeks or months or years, days at best. The market determines what the rates are based on the supply and demand of bonds. The supply of and demand for bonds. That's different. Fed doesn't have any control over that.
Yeah. What I want is for you to have the proper portfolio, for you not to react to things that appear to be so obvious, and for you to stop some of those bad habits that we do see people may have that get them into trouble in times of change. That's the problem.
You may think you know things because you feel things, and sometimes our feelings feel real, but they're not. You don't know nothing about the future. Nothing. You've got to just do that boring stuff that Tom said, build the right portfolio.
Well, and part of it is, by the way, not to look at your portfolio, the value of your holdings often, because the people that do that, they often make mistakes too because, hey, look how much I've lost. I got to do something.
Well, I love the
That's
fact that Jason said throw some friction between yourself and watching CNBC and things. And I'm seriously thinking about inventing a little shock therapy thing that you strap to yourself. When it hears CNBC, it gives you a jolt.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Hi. Hey, how are you? Welcome back to our little get-together we call a radio show, and then in a few days we'll call it a podcast. It's multi-purpose. We try to be all things to everybody everywhere when it comes to money. We do.
Okay. I'm agreeing with you finally.
All right, you know what I'm going to do? I'm going standing. Hold on. I'm moving the desk up. Right?
Whoa, this is real time too. Look at that.
I'm moving the desk up.
Wow, that's kind of freaky. Either that or you're getting shorter. I don't know which.
All right. Oh, hey, that feels good. I've got this new desk that's way cool because it has a little motor.
It does. I saw that working.
And it goes up and down just like that. So now I'm a standing desk. Hey there.
You're not actually sitting and the chair just went up. Anyway, so okay.
All right, let's get to another call at 855-935-TALK, 855-935-8255. Tony, you're up. Welcome to Talking Real Money.
Hey, guys. How's it going? So I have a question about holding bonds for someone who's younger. So I'm 31, and I know that there's that rule of 110 minus your age. And so I know some people would recommend that I would hold maybe 20% bonds in my portfolio, but I know also there's some people who are saying that people my age shouldn't hold any fixed income in their portfolio right now. So I was wondering what you guys thought about that. And one other quick question. I do believe in the long-term passive index style investing, but I kind of like the idea of holding more than just like a 2 or 3 fund portfolio. And I was thinking about maybe adding some like international small cap or some REITs or something in addition to holding a total U.S. and a total international. So I'll just wonder.
All right. Well, I'm gonna answer your first question, and then Tom's going to go from there because my answer is really quick. Both of the people are wrong. Both parties are wrong. There is no rule. There are no absolute rules. There's no age rule.
By the way, I will say it's the first time I've heard 110 minus your age. It used to be
100 minus your age.
Somebody added 10.
So they just make this stuff up to write an article or to fill some space in a newsletter or whatever it might be. There are no rules of thumb that you should follow. It's personal.
The rule is how much volatility at age 31 you're willing to accept. Because if you're willing to see your portfolio go down by 50%, you should be all in stocks. And by the way, since you're saving a market that gone down, that's good news because now you're buying more shares at a lower price. So Don's right. So an easy way to find that out, by the way, you could go take the risk quiz. It's free. I think you can go to Talking Real Money, take the risk quiz, figure out what your sort of
TalkingRealMoney.com.
Yeah, TalkingRealMoney.com.
Now, for the second question. Second question was, I don't just want to have VT and I want to add some other stuff.
I think that's fine. I mean, for example, you could own the total U.S. and total international and then add in 20% of a small cap exchange traded fund. We like VBR. We like AVUV. Those would give you a little more exposure to that part of the market than you're getting by being in one of the total market funds.
Does that help?
So you would, are you guys still there?
Yeah, we are.
Yeah. So would you hold like VTI as like a core holding and then add in the VBR or like a VNQ or something like that? Just have a little bit.
I would hold VT. I would hold VT as the core, not VTI.
Okay.
VT is the core,
Okay,
and then add a VBR or an AVUV or DFAs. They now have a small cap.
I don't know if that's available yet.
I think it is as an ETF because I think I have it.
Okay.
Yeah, I have
anyway,
it.
So
I have
those are
it.
three families that we trust: Vanguard, Avantis, and Dimensional. So what Don's talking about is owning V as in Victor, T as in Tango.
He
that's
loves
a global
his
global
military.
because we got a guy that got mad at me because that's the global, and then you add in one of those small cap value type of funds, gives you a little more exposure to that part of the market.
There you have
And
it.
you would say about maybe give or take 20%.
20 or so.
Yeah, I think that's reasonable. Sure. Mm-hmm.
Yeah. Maybe add a REIT fund down the road or
right on.
something. But all right.
All right, thank you.
Thank you. Take care. 855-935-TALK is our number. No, DFA does not have one. I have DFA for my emerging. I have Vanguard for my small cap value.
By the way, in terms of bonds,
And
if
Tom's
you're
beating
80
me on
and
that,
you're
too.
willing, if you're 80 and you're willing to have your portfolio go up and down by that sort of thing, still makes sense to own more stocks because stocks have made more money than bonds.
That's why I say there's no such thing as an age-based
agree.
rule. There's no such thing. So let's say you're, as Tom said, you're in your 80s. You have from pensions and IRAs and all that stuff, you've got income coming in that is far in excess of whatever you need to live. You understand the market. You've been investing for decades. And you know they go way down, and you set comfortably through 2000, 2001. You set comfortably through 2008, 2009. You didn't panic. You didn't do anything. You had a portfolio totally in stocks. Stay in stocks. Knock yourself out.
Yeah, it has been the more profitable way. The only thing in terms of the bonds do supply is a steady base so that when you need to pull money out of an account, that's not moving around because sometimes if it goes way down, you take that.
But again,
that's a fine
in the person who has that income coming in, they don't need to withdraw. Then you wait it out. How long can the market stay down? I mean, it could be years.
Mm-hmm.
We've seen some 5-year periods where the market was down after dividends and reinvestment and all that. Because bear in mind, some of those tales they tell about the Great Depression,
Oh, good Lord.
those are all manipulated because what they're doing is they're just telling you it's based on the market value. They neglect to talk about the power of the dividends, which were huge back in the 20s and 30s by comparison, and the reinvestment thereof, you would have recovered in relatively short order. So,
by the way, you mentioned 2000, 2001. You mentioned 2008, 2009. You did not mention the spring of 2020.
Because it
That
didn't
was the
last very
fastest
long.
decline. I know, but it was the fastest decline in history, I think.
I mean,
or something.
well, if you blinked, you missed it. If you were,
Yeah,
if
it
you
was
had
over fast.
if you
That's
had
true.
COVID, you missed it.
Oh, that's not even funny, but I'll let you say it.
855-935-TALK. Susan, you're up next. Welcome to Talking Real Money.
Well, hi. Thanks, guys. We ended the year on a high because of your recommendation for the paper plane cocktail, and you took our libations up a notch, so thank you for that. But I'm starting off this year so frustrated because I'm stuck between a financial advisor and a tax preparer, and I don't know what to do. One tells me that I should go to the other for help with tax planning, so at what point do you just throw in the towel and get a CPA?
Okay, well,
Okay,
first,
now were you-
first
yeah, we gotta
wait,
go back to
hold
the
on.
libations.
Hold on. I am not answering your question until you explain to me what we are talking about. Paper
The
airplane
paper
cocktail?
plane. Somebody had mentioned in one of their letters that you read on air about their favorite drink was a paper plane. And we looked it
I
up.
don't recall. I don't.
Well, it's
okay.
a fabulous cocktail, and if you haven't looked it up yourself, you need to do that.
I'm going to do that right now, but then I'm going to take a break for a minute or so, and then we're going to come back and talk about your CPA question.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Here's a phone number, 855-935-TALK, 855-935-8255. Just looked up the paper plane cocktail recipe, and I'm going to go have one of those. That
why
sounds
not?
really
Saturday
and it's sort of
evening.
orange colored, and I'm watching the the awful Broncos play here in a minute.
You are. Your team about to go out in a flame of something. By the way, so we're talking to Susan,
Yes.
and she is stuck between literally the rock and a hard place. I mean, between the CPA and the financial advisor. Here's my advice,
No, it's
Susan.
an accountant and a financial advisor.
Okay, accountant.
No, it's
and
an enrolled agent, a tax
Oh, it's an
preparer.
enrolled agent.
Okay. Yeah.
An enrolled agent
here's
and,
my
and somebody.
and a financial. Yeah. I would just find a new party. That sounds like a horribly boring place to be, if you ask me.
Although
paper
the
plane
paper plane
cocktail
cocktails
aside,
will get you
no,
through that.
Yeah,
They
maybe.
will.
I'd have to have,
No.
a number of those.
Now, do you do your paper plane with gin or bourbon?
Bourbon.
Yeah, well, there's two kinds.
okay.
Bourbon sounds better.
And
I
what's
got,
your-
I
what's
got
your
Maker's
bourbon
Mark. I got
bourbon
Maker's
selection?
Mark downstairs. I'm going.
Oh, okay. What's yours,
Yeah,
Susan? Which
yeah.
bourbon of choice do you choose?
Boulet.
Oh,
good
top
choice.
shelf. Okay, yeah, that's
She's a very
way
fancy
above
woman.
where I am.
All right, Tom, help her out here.
Okay, so what I'm trying to make sure we know what we're solving for. So you're trying to plan what you're. I mean, so tell me a little bit more about
What kind of advice are you looking
Yeah,
for
what are
that
you
they're
looking for? Yeah.
tossing back and forth?
We want to do drawdown planning and long-term tax planning.
Okay,
And-
wait a minute. I got to get into this. Hold on. I'm going to stop you right there. Wait a minute. Your financial advisor is telling you they don't want to do planning to help you figure out the distributions, tax planning?
What we're told is that the organization he works for, the custodian, Fidelity, doesn't do tax planning.
Oh, okay. So
Yeah. They don't
they
like to
won't
give
let him
I could see
do
that.
it. Yeah, all right. I'm sitting down
Yeah.
now because I'm upset.
Yeah, no, so again, that
nice.
might be a
Have
reason.
a paper plane.
That might be a reason to find an independent
Yep.
registered investment advisory, because they certainly should, and they would sit down and look at all those factors and say, and by the way, this is going to be a year by year thing because it depends on your accounts.
Yes.
There's a lot of things. I mean, so when you say long term, a little hard to do that because
Susan,
taxes could change. So
How much are you paying this advisor at Fidelity a year?
Well, because of the amount of assets we have invested with them, we pay just a small amount of fees in some of the different funds that we have. So we're paying right now about $20,000 a year is what it ends up being paid to Fidelity.
Okay, Tom's eyes just went really wide.
that's a lot of fee.
Yeah, how much money?
Well,
Ballpark.
we have some that's being managed. So we've got held in one account stock that was accumulated by working at a company that we haven't divested from.
Yeah.
So it ends up being collectively about $15 million.
Oh, okay.
Okay,
in
well then
case,
that's
fair,
not
sure.
a bad
Yeah,
fee.
no,
But
not at all.
I got to tell you, you could probably find a whole slew of independent registered investment fiduciary advisors who on $15 million wouldn't charge you more than that and would give you the kind of advice you're looking for.
And by the way, I'll do it for
I'm
15.
just shocked. Yeah, Tom will do it for 15.
That was easy. Yeah, no, okay, but again,
I mean, that just-
Fidelity may have some
They may have a
rules as
rule, but it's a
that
silly
say they can't
rule.
do it. I agree. You should be able to get that advice without having to go to a registered agent that would tell you. By the way, most CPAs, accountants, whatever name you want to put on, they're going to be looking back, not forward. Most of them are going to be reticent to say, here's what we think you should do for the next year, 2 years, 3 years, that kind of thing, generally.
Yeah.
All right.
But you may
It's
be.
hard
It
to find
just
somebody who's completely fiduciary and not.
That's the key. Is the see? I know at our firm we would then, if need be, work with an accountant if things got complicated. But for the most part, when you're a CFP or even just a rarely good advisor, you darn well better know how to tax plan for your clients, and that's part of the service offered. And that's why we say when you get to be a bigger client, when you have more money, that's when you start to need advisors. When you're just getting started, doing it yourself is fine. Later on, it gets more complicated. And I understand they may have that rule, but I think I'd probably, just for the heck of it, do a little shopping around so you have a one-stop person or people with whom you can do all of this for the rest of your life.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com, Vestory.com.
Reality radio for a really great future. We're talking real money.
All right, my awful football game has started.
Your last game of the year.
It's my last game. And I do actually kind of like that. It's like, okay, it's over. Thank goodness.
Get on to
just get some coaches fired and find a quarterback.
Else. Yeah.
This is not football talk, though. This is money talk. I'm Don. That's Tom. 855-935-TALK. TALK 8255 is our phone number. Do phones still have letters? I'm looking.
I don't know.
Oh, yeah. Mine does. My iPhone, TALK 8255.
I hate that. Yeah, myself.
I know. You hate so many things, Mr. Curmudgeon.
It's impossible to figure
I can't,
out. Give the number.
He's already grumpy like an 80-year-old man at 60.
Remember, because I'm going to be more positive this year.
Yeah, so he says. That'll last for actually, didn't it last for like a day? And then the first advisor meeting was like, okay, that was over.
That's true. Yeah. It wasn't very long, was it? Okay.
It didn't last long at all. 855-935-TALK, or you can send questions in. You can speak them in, too, at talkingrealmoney.com. But some people...
I've got a question.
I have a question? You have another one?
I do. This is from Eric.
All right. Since you just interrupted me asking a question, go right ahead. I'm going to answer.
He says,
I am ready.
He says he's got a question about VTI.
Oh, your question sounds boring.
Now, VTI is
the Vanguard Total U.S. Index.
Right. So
which makes no
international
sense
stocks.
with a symbol like VTI.
I know. You would think it'd be the other. That would be the international. But anyway, because he says you only need to invest in VTI.
Just go ahead and read the question.
Okay. I don't want to get too. It's reading a book about investors. Index is the only way. I know. Big surprise there.
Okay, yeah.
He says you only need to invest in VTI because many of the holdings are considered international at this point. Microsoft, Google are really worldwide companies. In other words, if you invest in the U.S.,
I've heard this argument before.
Yeah, you get exposure to international markets because Microsoft does a lot of business overseas. Mm-hmm. Google does a lot of business overseas. Boeing does a lot, et cetera. You get that point.
Yeah.
But here's the thing. That we do know. Most of the return you get from international stocks is due to the economies that they are a part of. In other words, you need to have direct exposure to Germany, to Japan, to Russia, these places where the economics are actually playing out in that fund. You do not get that by just owning the U.S. market and hoping that the stocks that aforementioned, the huge companies, are being greatly impacted by what goes on in those other countries. A lot said there, but the bottom line is I would still be globally diversified.
Well, okay, let me just add one other little silly thing to that. And it's not so silly. If you look at the VTI, yeah, they have a lot of big companies that have international presence, but they're also missing a lot of big international companies that have a major U.S. presence.
Good
like
point.
Volkswagen
Nestle.
Or Toyota or Nestle or
who's the beer guys?
InBev. They're not U.S. companies. They're overseas companies, but they have major presences here in the United States. So you want as much. Why would anyone say you don't need any more diversification? Why? It's
John Bogle used to say it.
I know, and we argued with Jack.
We did. We did actually argue.
It just seems like a silly argument when you can get the whole world for about the same cost. Why not more? When it comes to diversification, we believe more is better.
Thank you for your question, Eric.
Better.
And yes, index funds. Remember that in case the next time you're on Jeopardy, too. Index funds.
Well, speaking of index funds, that's our next question. It's index funds. That's the subject. I hear you talk about index funds. The S&P 500 seems to be a popular subject. But what other ones are there? And in theory, shouldn't all S&P 500 funds have exactly the same rate of return? If so, why would someone be in anything other than the one with the lowest expense ratio? Thanks, guys. Learning is so much fun.
Well, the second part of your question is exactly right. If you want to own the S&P 500, I think you can still pay like 1%. I think ProFunds has some 1%
Yes, there's a
thing.
1% S&P 500.
Sure, go
fund.
ahead. Your return will be less than as you correctly point out, the one that charges like 3 basis points or whatever you can get it at Schwab for now. It's ridiculously cheap. In terms of other indexes, I believe, and I think this is from the book Trillions, there's like 3,000 indexes. There's a gazillion. I mean, there's index for everything. Do you need all those? Absolutely not. We can talk about the few that we do.
Do you need more than the S&P 500?
Yes, you do.
We're going to talk about some of those coming up right after this. 855-935-TALK.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
855-935-8255. You know, there are a lot of indices or indexes. You know, both are actually correct, I think.
Yeah, they are. Yeah, I mean, I think in Robin Wigglesworth's book, he said I think it was like 3,000.
Well, I'm looking right here just at the major ones for different companies. I mean, we have the Dow, the S&P 500, the NASDAQ, the small cap 2000 Russell, S&P 500 VIX, the S&P 500 TSX from Canada, the Bovespa from Brazil, the DAX, the FTSE, the CAC, the Euro stocks, the AEX, the IBEX, you want to make yourself the Nikkei, the Budapest SE. We even have, down here, the Karachi 100. There's a Pakistan
market. I think I
market.
did last Friday night, and I got arrested for it. But here's the thing. You don't need all those.
No.
No, it's ridiculous. Okay, so, and oftentimes we talk about how you can use 2 exchange-traded funds at Schwab, at Fidelity, at Vanguard, where you own basically all of those things Don just mentioned.
Which basically is the MCSI index, which is the whole world.
Yeah, or you could... Because when you own those 2 indexes,
index fund,
you end up with a lot of large companies. So you could add in that by having a smaller index,
which might be the Russell 2000 or something like that.
Something like that. But other than that, you don't need a whole lot of other stuff. It's ridiculous.
No, we just need to get to another call though at 855-935-TALK. And Jennifer, you're next. Welcome to our little show.
Hey there. I have a question that I'm not sure if this is something you guys can even answer. Your screener wasn't sure, but it's my daughter and her husband live in Eastern Washington, and they're going to be moving over to the west side. They obviously have to sell their home first before they can get another mortgage, and so what would make it easier for them is if I bought the house ahead of time and somehow sold it back to them or quit claimed it to them. But they would need to get a mortgage, right, of their own to buy it from me. And I'm just wondering, is this even possible? I mean, do people even do this?
I'm trying to figure out what you're trying to accomplish by doing this. So you would buy it from the house in you would buy the house in Eastern Washington from them.
Yeah, right.
Okay.
No. They would sell that. They're going to make quite a bit of equity on it. They would sell that on their own, but they want to be able to sell and move right. You know, they don't want to have an interim period where they don't have a home because they need to sell their home. That has to close. They have to move out, and then they'll need to buy a new home then in order to qualify for another mortgage.
There's things. There are things called bridge loans.
Yeah.
I did it.
I don't think they're going to be able to do that.
They won't qualify?
I know, but they're just getting started. I don't think so. They're early 20s. I don't think so. I don't think they have a. Yeah, well, they're doing awesome.
That's great, Jennifer. Real quick. Let me interrupt. Just very quickly. Have they identified the home in Western Washington that they want to buy yet?
Well, so that's the thing. She's identified several homes that she'd love to buy, but they can't. They can't even think about it until they sell their home.
Well, but they could put in a contingent contract.
Yeah, but all the realtors are saying
no contingencies.
Those will never get accepted. Yeah, they're not with this market right now. And so I just had this idea. I thought, what if I bought the house in Western Washington?
Right.
Like, let's say they found one today, and they're like, yeah, let's buy it, and we'll move in 3 months. And I'm fully capable of doing that for them. And then, but my question is, how do I sell it to them or quit claim it to them and not incur a financial hardship for me? So, basically, like sales tax. I guess they would have to pay that if they bought it for me. But
there are going to be
taxes.
Yeah, there are going to be taxes on both transactions.
Right.
You're going to have taxes.
Quit claim it?
Who's going to keep paying
income tax, right?
Who's going to pay the mortgage? Wait, okay. Are you going to buy it with cash?
No. I would get a mortgage, and then I would sell it to them, or I'd quit claim it to them when they got their new mortgage. You're going to find the same
problem in that mortgages are no longer assumable.
Okay.
So you can't just say, okay, I'm going to give them my mortgage. No, your mortgage was for you.
I knew that.
But
will a mortgage? Yeah.
Well, I'm just confused, Jennifer, because if you quit claim it to them, you give them the ownership. That's what quit claiming means.
Yep, handing over.
Mm-hmm.
So what you would have to do is sell it to them. They would have to get a new mortgage to buy you out.
Okay, so we would just have to pay sales tax on that twice.
Right.
Okay.
Which wouldn't make sense. It's excise tax, which wouldn't make sense to me. I mean, again, what you're really solving for here is sort of that interim period of time between when they sell their home in Eastern Washington and when they're able to buy another one in Western Washington. That, to me, is what you're solving for. I mean, I think the smarter thing is to go find go find a interim place to rent for a period of time, and then, but plus the fact that if you're just moving to a new area, maybe you're trying to figure out where the right place to live is anyway, based on
it. Just strikes me you'd save a fortune if they just rented for a while, leaving that acquisition open-ended and far lower pressure. Even if it means renting something small and getting an inexpensive storage unit for a year to slow the process down. I know in your 20s, everything seems to move slowly and you really want to push it. But you're older. Things move fast when you get older.
I was she emailed me today and said, could you buy this house for us? This is the one we want.
She's eager.
We can't buy it.
She's like my 27-year-old who just had to buy something. And I just said, good luck. You're on your own. Hope you can figure it out. She did, but she's strapped. I would encourage slowing it down, taking a deep breath, moving to the western part of Washington, getting to know the neighborhoods, learning the areas you like. And the other thing that might happen a little bit, maybe some of this calms down a little because
it has already.
It's been a bit frantic.
It already did. Yeah, and that's another reason not to run out and buy anything. If I was in the buying situation right now, no way. I would be waiting because I'm not saying prices are going to go down, but I will say the expectation is inventories may level out.
And even not even from a timing standpoint, but just from a sanity standpoint.
Well, and with higher interest rates, that probably means you will see a less volatile market in the coming months.
So that's what I do. Oh, good luck, Jennifer. We really appreciate the call. 855-935-TALK is our number. Remember, you can call that 24 hours a day, 7 days a week, too. And we'll answer those questions on future podcasts. We'll be right back. Don't go anywhere. I'm Don. That's Tom. Hanging out, talking real money.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
For all of you who are thinking about attending Retire Meet, we are postponing it due to COVID.
Yeah, we're going to move it back to Saturday, May 14th. Same great event. We'll do it in person and we'll do it virtual. Same speakers, we hope. And that's just the way the world works right now. We will still offer you our help with an advisor if you want it right now, of course.
Yeah, all you have to do to get that is just go to our advisory website, which is vestory.com. Set up an appointment with one of our advisors. They will help you. There will be no cost, no obligation. And here's the coolest thing, no high-pressure push to buy something. You'll get really actionable advice for free. Really. Just go to vestory.com, VESTORY.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. And to keep the lawyers happy.